Frontier Advisory, in conjunction with the JSC, hosted yet another Africa Frontiers forum last night, and this time the theme was how we should be thinking about enhancing business competitiveness in South Africa and the region as a whole. Joining me at the desk right now is Martyn Davies, CEO at Frontier Advisory. We're going to be kick-starting the discussion. Mila Matola, unfortunately, stuck in Johannesburg traffic this morning, so hopefully he'll get to join us a little later. But for now, Martyn, thanks so much for joining us and making it through the traffic successfully this morning.
It's rough out there.
Let's take a look at things. I mean, WEF recently released its annual competitiveness report for 2011-2012, and South Africa and Mauritius led the competitive rankings in Africa. Overall, what's your perspective on where South Africa and the region stands right now in terms of competitiveness?
We have this very interesting trend in that we have robust growth in Asia and enhancements in competitiveness. Particularly the last 10 years, it's a China story, it's an Indonesia story, it's a Vietnam story. In Africa, we have, albeit not quite as robust, but very strong growth. And yet we have, generally speaking, declining competitiveness. Now, for me, in the discussion last night particularly, as growth is only sustainable, I would argue, with commensurate returns in productivity and competitiveness. So what are we as a region perhaps doing to move away from sort of resource-dependent economies, generally speaking, obviously SA is different, to really drive sustainable development, i.e. returns, enhancements in productivity and returns in competitiveness?
What are we doing?
You know, I think the major impediment perhaps, and this was sort of underpinned with discussions yesterday evening, was the disconnect between the state and the business community, particularly in South Africa. We have, and I think most people will agree with this, is a low trust political economy for whatever reason. We need to start to narrow that gap and form a more coherent vision, a coherent view, and above all, coherent implementation around how we start to drive competitiveness in our economy. Yeah,
let's take a look at some of the factors that would, of course, come to bear. I mean, you've got being competitive, the cost element associated with what we get out, in terms of productivity at the end of the day, having to be addressed, and that's why we have such a tough time competing against cheap Chinese imports. So let's look at the cost imperative, specifically speaking, where South Africa's labour costs, administrative costs, etc., have all come to bear on business at this stage. What kind of hindrance is that operating environment?
I would argue it's not so much a cost issue as it is a productivity issue. I mean, how does Germany remain such an industrial manufacturing machine, a giant? It's a high-cost economy. It's not about costs, it's about productivity. So, you know, in China, for example, you mentioned, we're seeing, you know, routinely as double-digit wage inflation. And that is sort of what we're having in many instances in South Africa. However, in China's case, you're still having productivity outstrip wage inflation.
So that ratio is still being maintained, even though you've got escalating costs moving high.
Correct. Hence, Germany is still competitive as a manufacturer, very much so. So I think we at times get maybe too focused on the cost issue and arguing that our cost of labour is X amount compared to China or India or Southeast Asia, whatever it may be, rather than saying what's the productivity issues in our economy compared to this.
So let's drill down into the nitty-gritty. I mean, what are the productivity issues that need to be addressed?
Well, it's the usual thing. First and foremost, top of the list is talent. And we call it, you know, maybe education, whatever. But how do you sort of, you know, manage, firstly build, manage, and maybe even cluster around key sectors, cluster talent for competitiveness. This is certainly a Michael Porter, you know, the guru of strategy, Harvard Business School approach. Clustering, manufacturing, not just manufacturing, but even service clusters for competitiveness. And that's certainly been the Asian story in the last 20, 25 years or so, from Singapore up to South Korea. I think secondly, it's around obviously enabling infrastructure. Infrastructure in itself is deflationary ultimately. So how does infrastructure enable manufacturing and for goods and products to flow around the economy? I think thirdly, it comes down to, you know, and this is a very sort of maybe more intangible thing, but are we as Africans or South Africans, are we willing to take the pain to get 6, 7, 8, 9%? It doesn't come with a 40-hour work week. It doesn't. Are we willing to make those sacrifices? Are business, is government, and from a cost-cutting perspective, is labour particularly willing to take the pain to drive growth in our economy?
Certainly, those are the primary reasons being cited as to why foreign multinationals you know, and those enterprises in general, you know, never mind China, have not seriously advanced into the continent in search of, you know, investment potential, manufacturing potential, because of these kind of factors that impede competitiveness. Let's take a look at the role government needs to start playing in this entire scenario?
I think what just general characterization in the Asian context, generally speaking, and there's obviously a few exceptions, but generally speaking, the state is the entrepreneur. The state is the driver of economic development in terms of not so much intervention, but more about enablement.
Yeah.
Very, very pro-business approach. And sort of the key performance indicators, the KPIs of even government bureaucrats and government departments are such that it's an extreme economic sort of focus. I think we in South Africa, and it was said yesterday evening, trying to maybe perhaps please too many interests too much of the time, rather than just going through the growth and cutting through, cutting straight to the chase of what actually drives competitiveness.
Let's take a look at favourable trade conditions. I mean, where we have found it difficult to compete in a global arena, specifically against China. What kind of trade conditions should we be putting out there? Do we have the muscle, the confidence to establish new rules of engagement within a global economy?
Well, Alishia, this is a big thing. You mentioned the key word confidence. Do we have the confidence? I see Asian states, Asian political economies far more confident than typical ones in Africa around setting the agenda, setting the tone of engagement. For example, there's an argument, and one I tend to agree with generally. Post-94 in this country, we embraced market fundamentalism perhaps too quickly. We liberalized, we opened, and that's, generally speaking, it's a good thing, but it depends on what speed you do it at. And I think it's a question of protectionism for market fundamentalists becomes a dirty word. But protectionism at times is not far off pragmatism. How do we sort of start to support key industries? Not ones which swimming against sort of the economic competitive tide from globalization, but ones which clearly align to our commercial national interest.
Exactly. I mean, Chinese manufacturers leverage off those government initiatives specifically, and that's what gets them to produce product more cheaply than other producers around the world. And some have even asked the question, what would happen to China if it had to stop giving export incentives, for example.
Sure.
But that's a question to be answered at another time. We've run out of time, Martyn. Thanks so much for having joined us this morning. Martyn Davies is CEO at Frontier Advisory.